Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. We're going to go over a couple of questions here. I think they're really good questions. I'd like to share it with everybody. One of them was sent to me through the website. Other one was posted on the finding-value.com website. So I do think that they're well thought out questions, and they're very good questions. And I'll give you what my opinion is and kind of my viewpoint. And again, my background, I'm an engineering major. I'm in the lean manufacturing type area. So I look at things, and I look at processes, I look at problems, and I develop solutions from root causes. So I dig down into complex things, and I try to find the source of problems and fix those problems. And you can also look at things that cost many millions of dollars, from high level type things. What you do is you look at the data, you look at things, and then you dive down and fix things. That's my approach to basically investing, and what I've used as an approach. So these questions, I'm looking at it from that paradigm. I'm looking at root causes. I'm looking at statistical probabilities. I'm looking at technical analysis. I'm trying to combine absolutely everything I know from the markets to deploy what I've learned to get the advantage in the markets. Now, let's read through this real quick. I'm going to zoom in a little bit more here so you guys can see it. Okay, it says, Andy, are we in the beginning of a mania phase with Intrepid Potash? How do you scale out in such vertical going stocks? I think we will see similar moves in uranium stocks, but there will have a benchmark to look, the spot price. Without such a sign, what is the trigger to take the chips from the table before the roller coaster leaves the top? To get in a good stock is one part, but to get out of the monkey trap and let some nuts on the table is another thing. Maybe a good story about signals and psychology for a YouTube video. That's what we're doing here. We need the psychological preparation for the coming bull market in commodities. I think many people will have problems with vertical stocks to identify the right point to jump out. It's a very good question. And I had a lot of questions or statements, I should say, of people on our last Zoom meeting in the Finding Value website about mentorship, about the mindset, the psychological power to hold on, to know when to sell. There's a lot of questions that are similar to this. So what I'm going to do is, again, when I look at things, and I'm trying to formulate this large, complex answer for you guys and simplify it as best I can. What we're trying to do is identify trends. That's really what we're trying to do. And what causes these things to go up is money flows. So we need to identify where money is at, where money is going. That's what we have the ratios for. And the ratios tell us where the money is and isn't. And the money flows is what changes the valuations in those ratios. It's what is flowing into these stocks that you are saying. So when something starts to go, quote, vertical, it means lots of money is entering that stock. Now, being able to identify where we're at is very important. And I use ratios to do that, and market conditions. Market conditions is what's providing the trend. The market, and what I mean by market conditions, the housing market, in my opinion, is what's providing the liquidity to the system. In addition to the Fed, there's liquidity all coming in. But the way it gets into the hands of people is through loans. That's the increase of the M2 money supply. That gate has to be open. Otherwise, they have to literally send checks to people directly. That's how you get it in the hands of people. If you create money and you just put it into the banking system, it doesn't go anywhere. They can do stuff with it. They can invest with it, like they did. That money went into stocks and bonds, but when that rotates back out because of the market conditions in real estate, high inflation, increasing interest rates, it redirects money in that system. So the redirection of money in the system is what's causing these stocks to go up. And it just started. How do I know it just started? Well, we also want to look at ratios, and that's, I'm a big ratio guy, you know? And when looking at ratios, I can look at, say, something like a commodity to stock ratio. And there's also the housing starts. So this is the commodity to stock ratio. I'm going to get out of here real quick. And if you look at the big picture view, we're just starting to break up. We're starting to accelerate a little bit as we move on. So we are eating through some of the value already. And I've been talking about this on the channel for a long time. This is where the bottoming was. It was a bottoming process. We've walked through it through videos on our YouTube channel. And I'm saying, hey, look, let me get off the log scale here real quick. I said, hey, look, stocks are outperforming during this period. Now commodities are going to outperform of what's coming. We've broken that downtrend. The trend has changed. Now, I think that this trend it could be violent as we move up. And this is your valuation runway for commodities to appreciate against stocks. Now, are we going to get all the way to the top of this? I probably think so. I mean, that's my case. What justification do I have to say that? I think it's going to be the money rotating out. And this will rotate back over. And it's a self-feedback loop. What is a self-feedback loop? When money goes into commodities, commodities go up. When commodities go up, we'll see that in the consumer price index, which then will increase interest rates higher, which will then force more money to go back into commodities. And it's a feedback loop of money going into commodities, then changing the inflation rate, which then changes the interest rate. And it feeds on itself over and over and over until that cycle is complete, or until the driver of the inflation ceases to exist. In my opinion, the right market conditions for those drivers is in the housing market. It's called the housing starts. The housing starts and the volume of the housing starts, it's the loans against the housing starts that is the market driver of this. We've seen this in the past. We've seen it before all deflationary crashes where the driver goes away. We get a crash in the mid 70s, the late 70s, early 80s. We get that crash. We got the crash from 08, which is 07 is when it threw the signal. And then we had the crash in 08. What this is telling us is that a large percentage of inflation and deflation drivers comes from the United States housing starts. That's where the vast majority of the driver is. It's not 100%, I get it, but it's probably 80+% or more. And the alignment that we have today is that we've got a large commodity bull market that's coming. It's a super cycle because we're going to have literally we're going to have a molecule crisis where we don't have the stuff in the pipeline to meet all of the demand. We are going to have deficits and prices are going to go quite dramatic. I think that's going to start in the 2023 timeframe, 2024 timeframe for the majority of materials. Not all of them, but the majority of them. And those squeezes are going to put an intense upward pressure on pricing. That's your fundamental setup. But in the background, you have the liquidity setup from this. So that you're aligning multiple things together here, where you've got liquidity coming into the system at the same time that you have underinvestment in commodities, where you can't really increase your production of commodities quickly. You have to build these mines, and these mines take anywhere from 5 to 10 years, depending on what it is. So we've got this alignment that's very rare in history. And the alignment that the things that I'm monitoring is, are the root causes of these things still intact? And can we measure it? And how do we measure it by? The things that are still intact is the housing market. We still have very low inventory, active inventory. That's why I go over the inventory on the channel so much. And it's not a huge winner in terms of views, but I go over it, and that should be a huge indicator of market conditions. And then, so that's the housing starts. Then we've got the interest rates. They're going up, the Fed funds rate. That's another indicator because that's what's causing the rotation of money. We can also use that as a gauge of what the Federal Reserve thinks. They think that inflation is going to be bad and they're going to continue to raise rates. If they're in the continual rate mode increase, if they're continuing to increase rates, the Federal Reserve thinks that inflation is bad and that we have to increase rates. I don't think that increasing interest rates will necessarily crash the housing market. What crashes housing markets is an excess inventory. Excess inventory. We are at record low inventories. Now, will the housing market slow down? Yes, it will slow down with a drastic increase in interest rates that we've seen. But I don't think it will be a crash because I don't know where the inventory is necessarily going to come from. So I think it will remain elevated and high, and it will highly depend on how many new homes, which is the United States housing starts, comes online and the pricing of those homes and the loans against them. You've got the M2 money supply, which the housing starts is still generating all of that inflation. So the drivers are still in place and the market conditions are still all intact. And it takes a few years for those drivers to, one, stop, and then two, actually work its way into the system. So it takes a few years. So I still think we have at least a few years ahead of us, at least. And if I were to take a random guess, it'd be probably 2026, 2028, 2030, somewhere in that range. Now, I can't tell you because the drivers are still in place. We don't have inventory going up of homes. And new homes and the pricing of new homes continues to accelerate higher. So it's a mix, and we see high rent prices. So everything is intact, in my opinion, for the generator of inflation to still generate. So that's what you need to be watching, is what is the generator of the inflation and the increasing in interest rates. And that increasing of interest rates will go up so long that the generator is still generating, in my opinion. So those are some things that I look at. Now, you specifically asked about IPI, Intrepid Potash. Intrepid Potash is a potash company. And the way that I evaluate things is I look at, number one, the chart of Intrepid Potash. So Intrepid Potash has this double bottom looking chart. I'm putting on logs so you can accentuate it. There's your double bottom. And we're coming on up and we've broken out. There's no resistance. Now, we're probably going to get a little bit of resistance coming here soon. We're getting up into that resistance range of about 115, 120. That's where there's other people that have traded. I said this thing's going to rocket higher up until this resistance area, and it may slow down some. Doesn't mean it's going to crash. The generator of inflation and increasing interest rates is still there. So if you were to look at the market conditions, what caused fertilizers to go up? In my opinion, it's natural gas prices. Natural gas prices and synthetic fertilizers are derived from natural gas. That natural gas increase in cost in Europe drove a shortage in nitrogen fertilizers. Now, some of these fertilizers, like potash and some of these that they have, will also be used as prices go up. And when looking at Intrepid Potash, we're basically breaking out of its pattern, the bottoming pattern. And it's just a fresh breakout. So when I look at things, Intrepid Potash, for example, is it's just broken out. And usually things don't break out of these large double bottom patterns and just fail. They may go back, maybe, and do like a retest, but there's no retest here as it came down. So I think we're just probably going to head higher. And the volume is confirming this move. And when looking at other companies in the fertilizer areas, they all look like they are progressing forward. So I'm taking Mosaic. And if you take Mosaic from a long logarithmic type move, you can tie this all together where we could potentially go all the way up to $500 on the stock price of Mosaic, which means that this has a long way to run. And the potential is, it doesn't mean it will, but the potential is there. And when looking at some of these other ones, they're all basically running up vertical, all of them. And I think we still have some room to run. Now, remember, I'm on logarithmic. Some of these I've done. This one still has a long way to go. Another 100% move in LSB Industries. Now, this is mid-stride. I don't like getting in on things that are in mid-stride. This is ADM, a completely different. This is an agriculture company. But IPI looks absolutely fantastic for a continued move higher. We may have a pause point at $117, $120 or so, because there's a little bit of resistance in trading there, where we pause at that general vicinity. And I'll let you know when the driver of these things stops generating. And I think that's when these will stop going up, is when the inventories normalize. Inventory is the interaction between the buyers and the sellers. It's a supply demand. And the inventory is that buffer. So if things are out of whack, either inventory gets added or inventory gets drawn. And looking at a lot of these different commodities, the inventories continually draw down, which means that we are in a phase that is going to go up in pricing because we're drawing inventories down and we don't have the supply side isn't really there yet. And I think this will last for 5 or 10 years because the majority of the there's two things here. There's two aspects. There's the numerator and the denominator. The denominator is your liquidity. That's the liquidity event coming from the housing market. Your numerator, because I'm going back and forth between these. The numerator is your supply and demand. The supply demand is not there. The supply. Your demand is there and your supply is not. We're drawing through inventories. It's going to be very bullish. At the same time that we've got liquidity coming from the housing market in. And in my opinion, the liquidity factor is a larger impact to the price moves. So I'm watching the liquidity factor through the housing market, which is the M2 money supply and inflation. So if your driver's still generating, I think that these will continue to go up because money has to seek something. And under inflationary times with increasing interest rates, that's what happens. Money rotates over into these. So if your generator of inflation is still generating and the interest rates are still going up, money's going to come rotating over, and it's a lot more money than you have in these sectors. These are small companies in relationship to the money that's rotating. So I think it's going to last for at least a couple more years, at least. And we'll look at that. We'll look at the companies in the entire sector. They're all going up, which means hang on, ride the trend. The trend is your friend until the end. And then we've got, everything looks good on it. So I that's all I have to say. Ride the trend. And we'll see the top when it comes. We'll see it in technical analysis. We'll start seeing larger down days, a rounding top, and all that other things. I don't think it's just going to go up and stop and come back down. I think it'll be slower in movement. Now, there's another question here that I'd like to read. It says, Andy, I really like your content analysis strategy. There are two flies in the ointment that continue to make me nervous about the commodity supercycle thesis. Although I have tempered my fears by confirming your cyclical ratios, etc., but wondering if this commodity bull might be too good to be true, so to speak, trying to be contrarian pressure to test the thesis. The first is an observation of what happened post-2008, when deleveraging resulted in the baby getting thrown out with the bathwater. Commodities crashed hard. Are we perhaps in a Fed environment that may cause a similar pattern? Looking at what is happening in housing with rates rising rapidly, could this be the start of a deflationary impulse? Don't fight the Fed. So I'm going to answer that question there. I already answered it already. So we're not fighting the Fed. The Fed is trying to slow a move that's coming that is demographic driven. Now, in order for the housing starts to go down, and this happened in the 1970s. Let's take a look at the 1970s and the housing starts. In the 1970s with the housing starts, it's right here. I'm going to zoom out, adjust, get off log. 1970s, we had that dip. The housing starts came back down. We had an excess inventory of homes in this time frame, and it came on down. So our inventory of homes was very high, and the housing starts shut off. And that was your deflationary blip. So this is your deflationary blip that you had in the 1970s in the middle. Then it turned back on. Your generator of inflation turned back on, and then it turned back off. And it remained muted because a lot of the demographics weren't as large. The alignment didn't happen again for I would say over here. This here was after a large boom in commodities. There was excesses everywhere. So the commodity alignment didn't exist during this little hump here, even though the liquidity came into the system. You need both of those things to turn on at the same time. We have all the alignment over here on the right-hand side, and we had an alignment, a mini boom in the early 2000s. We've got we had very large interest rate environment here coming up. That was a cycle that was ending. Now we have the cycle beginning of interest rates moving up over here. This was still in a declining interest rate environment, this whole environment here. So the rotation wasn't as dramatic. So in my opinion, what's coming is the generator of that liquidity is still generating. We do not have a high inventory of homes. The home market, the real estate market, is not in a bubble because it's being driven by a larger demographic called the millennials and home buying years. So you have to get this all right. And with the alignment that we have today, I don't see a housing crash to create the deleveraging event. That's my opinion at this time. And I will stay that opinion until the inventory goes into a bubble territory, which will take many years to get there. The second applies mostly to shipping per the Dry Baltic Index, is the aggressive movement toward deglobalization and our current environment of sanctions and collapsing trade. In such an environment where countries are each to their own with trade restricted, shipping rates might crash, right? I don't think so. I don't think so because, and the reason I say I don't think so is because all these countries don't have the minerals that they need. So you can't say we're gonna absolutely try to produce absolutely everything in this one country. They don't have everything. They can't do it. A lot of these countries don't have the landmass to grow the food that they need. A lot of countries don't have the minerals in that just location for them to use. So I don't think we can basically go backwards and deglobalize, so to speak. I just don't think that's possible. And if we do, it's going to be absolutely horrible. I think you'll probably see wars. That's just kind of my guess, because a lot of people are dependent on things that are grown and produced in other countries. And I just don't think we can do that very quickly. I don't think it's an on-off switch. A lot of people think that these markets are just on-off switches. They're not. It takes a long time to move things. It's like moving very large boats or airplanes that are heavily loaded, like an Antonov. That's just one of the largest airplanes, and it just doesn't move fast. It's not a tactical airplane like a jet or something, a fighter jet where you're just moving all over the place. They're not like that. These markets are big. They're huge. They're like Titanic boats that take forever to turn. And and they hit things and they sink every once in a while. But it's I don't think people think that things can happen too quickly. Their timeframes are all off. And that's another thing that I wanted to touch on, timeframes. To become a good investor, you have to match your timeframe to the market timeframe. It's not the timeframe that you want the market to behave under, because you have to buy a house in 2 years from now. The market doesn't care about that. The market's going to move slow, like it's always done before, with these cycles. And these cycles are long-lasting and slow. They're not fast to move and react. So you have to get your time frame right if you're an investor. You have to be patient. You have to watch the markets. You have to look at these things move. And then you have to figure out what the generator of whatever that thing is and determine where the money flows are flowing. And that's exactly what I did with the thesis. So I said, okay, money is what moves stocks. What moves money? And then what moves money is interest rates. Well, what moves interest rates? Inflation moves interest rates, either the lack of or the excess of. Well, what moves inflation? It's the house prices. That's what causes the inflation, at least what I've seen in history. So the driver of the pricing of all assets is driven by the real estate market in the reserve currency. That's what I found. That is the business cycle or real estate cycle. It's the same thing. And that's what I've found with the analysis that I've done looking at history. And the generator is so long that it's generating so ultimately the housing market is driven by the demographics, and the demographics is ultimately the driver of all of it. That is the root cause of the movements. Larger demographics causes inflation, which causes an increase in interest rates. The increase in interest rates causes a rotation of money, and that rotation of money is what causes asset prices to go up in other sectors. And we can see this using ratio analysis. It's pretty cool, pretty good thesis, isn't it? It took me a little while to figure it all out. Because another thing, and this is very difficult, a lot of people, even myself, were listening to other experts and they just don't have it right. I'm sorry, that's what drove me to figure this stuff out. And looking at only the fundamentals is going to get you anywhere because you don't know when the money's going to flow. If you only look at fundamentals, and the fundamentals change based off of money flows in a commodity sector. The commodity companies look the best at tops and the worst at bottoms, but you got to be buying them when they're the worst and selling them when they're the best. It's quite contrary to everything else. And the ones that look the worst at the bottom that aren't going to go bankrupt are the best, usually the best ones to invest in. So when people say, oh, I don't like the debt, they've got too much debt, that's where I start to look at. I like companies that people hate. Why? Because the money's not there. And when the money comes rolling back in, you're in the one that is the least likely. Well, the people think it's the least likely to prosper. But if it's a high-cost producer or if it's something that's on the edge or the limit, those are usually the ones that go up the most, are the ones that everyone discounts and says they can't do it, they can't do this. And I usually get a little bit of money in there. I still follow all of the portfolio strategy, allocation sizing, all that stuff. I still follow that. I never put all my money in one thing. But yeah, those are usually the ones that do the best. So I'm getting a lot. I see a lot of people, oh, Castor's not good. It's like, well, that's good. That's good. That's what everybody said about Bannerman when I was buying that at the bottom. We'll see how that one does. And I'm going to remain optimistic. Now I'm still allocating my 3, 4, 5% allocation. I don't go more than that. I'm still, holding to all these. I'm still spreading out. And I think it's going to take a little bit of time for the dry bulk shippers to turn around. I agree with that, but I don't think it's dead. And we haven't been building a lot of ships. So I think that's a positive thing. And it cycles just like everything else. And with war and all this deglobalization, what it's doing is it's actually probably increasing the shipping at some point because they're going to have to go further or farther in distance. They're going to have to go farther their routes to go around certain things. So again, remember, I don't put everything in one area. And dry bulk, maybe it doesn't pan out the way that we think it might. But we do have a commodity bull market. And usually in a commodity super cycle, volumes increase. And with infrastructure packages going around worldwide, I think these countries are going to want to produce more commodities, and we're going to have to move more commodities. But that's a guess. You know what? It's not 100% fact. It is a statistical bet that I'm taking, but I can tell you this: the entire sector looks like it's turning around. Money's flowing into those companies, and that's exactly what we look for. Money flowing in, chart patterns breaking, they're putting in bottoming patterns. And all of these patterns can be seen on the Finding Value website. And I show you what I think are some of the best picks in the dry bulk shipping area. I like dry bulk because it's more spot driven and related to commodities. And that's where I put my money. Does it mean that I'm right or wrong? We'll find out. We'll find out. All of the things that I track and measure are saying that the money's not there yet, and that money is starting to flow into it. So that's all positive attributes that I look for in a potential investment. So that's what I've got, and that's my answers there. Again, I think we are very early in this because we are just breaking these big bottoming or continuation consolidation periods just to the upside here recently. I think we've got a good ways to go. So that's what I think. Usually they run a good ways after these large structural driven consolidations are broken. Very rarely, I don't know if I've ever seen anyone in history where they did not run at all. So I think we're early to this mix, guys, very early. And we'll continue to monitor it. Come to the channel, subscribe, become a website member, and ask me questions. I'll continue to answer it. And if you don't like the answers, dig into it yourself. Find out what you can find out. See what other things that you've seen in history, and share it. And maybe I'll change my mind. Obviously, I'm pretty open to whatever you guys have to say. All right, guys, I'll end it there. Give me a thumb up. Subscribe to the channel if you haven't already, and check out the website. Platinum membership is the one that I would probably do. And then, you know what? We'll see you next time. This is Finding Value.